Crude oil just plunged 7.67%, a massive unwinding of the geopolitical risk premium that had markets bracing for a supply shock. Welcome to the D-Risk Weekly Global Markets Brief. It's Saturday, August 8th, 2026. Our theme this week is the relief valve. When the pressure of a Middle East escalation suddenly vents, capital rushes back into risk assets, completely ignoring the underlying economic slowdown. The biggest dislocation right now is how rapidly energy markets priced out a crisis, leaving equities to surge on the assumption of a friendlier Federal Reserve. Alex, let's start with the international tape, Asia and Europe.
Thanks, Sarah. In Europe, the lack of fresh macro headwinds allowed systematic buying to take over. Germany's DAX rallied 2.69% to 26,319, and the UK's FTSE 100 drifted 0.30% to 10,901. The DAX is riding a pristine golden cross structure, with its 50-day moving average at 25,130, sitting comfortably above its 200-day at 24,445. This clean technical setup means capital is flowing smoothly into European equities without fundamental resistance. Over in Asia, the picture is driven by localized data rather than global macro trends. The Nikkei rallied 1.93% to 65,607, stabilizing after recent volatility. Meanwhile, the Hang Seng edged down 0.84% to 25,668. The index is wedged between resilient Chinese export data and ongoing property sector anxieties, preventing any sustained upward momentum. Sarah, back to you.
That contrast between Europe's clean technical breakout and the Hang Seng's property sector anxieties is the defining story overseas. If capital is confidently riding those European trends while avoiding Asian real estate risks, how is Wall Street digesting this sudden geopolitical de-escalation? Alex, break down the U.S. and cross-asset signal.
Wall Street is fully embracing the de-escalation narrative, Sarah. Looking at U.S. futures, the NASDAQ 100 rallied 1.18% to 29,835, and the S&P 500 edged up 0.58% to 7,780. The prospect of a reopened Strait of Hormuz completely unwound the energy risk premium, acting as a massive tailwind for domestic equities. In the bond market, we are flying blind on the 2-year Treasury this week, so we will focus entirely on the long end. The 10-year yield rallied 1.30% to 4.69%, signaling that restrictive monetary conditions remain firmly in place. This elevated yield environment failed to support the U.S. dollar index, which drifted 0.20% to 99.60 as investors rotated out of safe havens. In commodities, we saw the week's most dramatic repricing. Crude oil plunged 7.67% to 78, confirming that the worst-case supply disruptions have been priced out. Conversely, gold surged 7.20% to $4,341, catching a massive relief bid as the dollar weakened. Finally, the VIX slid 1.65% to 14.90, reflecting a steady return of risk appetite as fear leaves the market. Sarah, back to you.
Thanks, Alex. The rapid unwinding of energy risk premiums proves that the relief valve is actively dictating global capital flows. When crude oil plunges 7.67% simply because geopolitical tensions ease, you know the relief valve is driving the market's risk-on reflex. Looking ahead, all eyes are on next week's U.S. Consumer Price Index report. If the inflation data comes in hotter than expected, watch for global equities to pull back and test key supports, specifically that 25,130 level we saw on the DAX 50-day moving average. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.